This is part 3 of chapter 14, Money, Banking, and the Federal Reserve System, where we actually get into discussing the Federal Reserve System a little bit, both their regulatory role in the banking system and a quick overview of their monetary policy role, which we'll go into in more depth in chapter 15 on monetary policy. So, why do we have a Fed? Why do we have bank regulations and a lot of things we're about to talk about? Well, the banking system is kind of the I don't know, the oil, the lubricant, the thing that keeps the economy really moving, right? Because what it does is it transforms, right, liquid assets. So like the money you put in the bank, for example, right, the cash you have, right, M1, M2, and it takes those bank deposits, those liquid assets, things that you can quickly go and use for transactions, and it turns them into long-term assets, right? Long-term borrowing of both individuals, right? Getting mortgages and companies borrowing money to invest, right? To expand their operations. Without that function, right? Without being able to get money from the people, right? The financial system from the people who have extra money that they don't want to spend today, but I want to do something with that, earn something with that, to the people who need more money than they have today, who want to borrow it, right? In terms of getting homes, cars, businesses, expanding operations, the financial system basically comes to a halt, right? So, and that's significantly what happened, right, in the turn of the century, and it happened often in the 1800s. So we created a Federal Reserve System, right? But we've already talked about what banks do, right, and in part 1 and part 2, how they collect deposits and they can lend out the rest. But if people get worried that this system, right, that their money in the banks isn't going to be there when they want it, right, that causes the whole thing to potentially collapse, which it has done before. And at the extreme case, it can cause bank runs. And you've maybe seen the movie It's a Wonderful Life, right, where people all went to the bank. They were worried they weren't be able to get their money out in the Great Depression. So they all wanted it out at once. And if you recall from part 2, when we talked about how banks create money, if everybody wanted their money out at once, they couldn't get it because it's not there, right? It's only a fraction of it is there. So that's called a bank run, and it basically can cause the bank to fail. And historically, right, if a bank run starts in one place, other people get worried, and it's contagious, right? A lot like the current coronavirus, it spreads, right? And that happened significantly during the Great Depression, many bank runs. So there's an example. And again, if you've seen the movie It's a Wonderful Life, that's a very good example of a bank run, right, and the challenges that it causes. Now, bank runs haven't been as frequent or significant or many in magnitude as it was back then, but it still occasionally happens, right? So the financial crisis, the Great Recession, happened in 2007 to 2009. It was basically a recession caused by people not trusting the financial system, and there were then as well some bank runs. So basically, a lot of things have been done to try to reduce, right, effectively provide an immunization for the system, so people aren't so worried, right, that there's going to be bank run, or that their money is not going to be available when they want it, to try to help avoid this, right? Try to avoid bank runs, try to keep the financial system working effectively, right? Basically, reduce fears, right? So the Federal Reserve was created in 1913-14 because of those types of panics, and it has two different roles, right? The one that we've been starting to talk about here is the role of regulating the banking system. helping to provide that financial stability, right? To make sure that the system is working well, right? To keep the lubricant working. The second is to manage the money supply, manage money in the economy, i.e. monetary policy, which we'll introduce really briefly in this chapter, but go into more depth in the next chapter. So again, this chapter we're going to focus most on the role of the Federal Reserve in regulating banks. So effectively, you have a bank. If you have money in the bank, well, banks have a bank, and the Federal Reserve is the banker's bank. It's composed, this Federal Reserve System, of 12 district banks, right? The one in New York, in DC, in Dallas, and basically 12 other regional banks throughout the United States to help do this oversight, this regulatory role. The member banks, right, have deposits at their bank, the Fed, and those member banks can borrow money from the Fed. Okay, so we'll go over those functions. And the group in the Federal Reserve that does the monetary policy is called the Federal Open Markets Committee, composed of some of the Fed chairman, the New York Fed president, and some of the other district bank heads, and basically meets periodically to discuss the monetary policy and changes in that that might be warranted based on financial circumstances. And again, we'll go into a lot more detail of this in the next chapter, just a little intro into it in this chapter. So first, how the Fed regulates the banking system, right, to help provide financial stability. Well, we've already started talking about that. Right? We've already talked about the idea of reserve requirements, right? So remember the hypothetical situation in part 2, right? When Shannon put $1,000 into Bank of MM, right? Well, Bank of MM can lend out a bunch of that, but it can't lend out all of that, right? So there's a minimum reserve ratio. What fraction of the deposits that get put in the bank can they lend out? So currently approximately 10% in the United States. So of that $1,000, $900 can be lent out, put in other assets. $100 has to be kept in cash in their vault or in deposits at the Federal Reserve. Okay, so we've already talked about that one thing to try to keep the system stable. Right? But when there's a bank run, if there's only 10% of people's deposits in the bank and 90% of people come and want to get their money out of the bank at the same time, it is not there, right? It is in all kinds of other loans and assets, such that that's when the bank run potentially causes the bank to fail. Well, so that people don't feel like they need to go get their money out of the bank, the government basically says, hey, we're going to insure your money, right? Up to a certain amount. So it's called FDIC insurance. If you go to your bank, you'll likely see a sticker somewhere or various references to this, right? Which basically says that for each account, right, up to $250,000 is insured, right? So if the bank did fail, basically the government gives you a check. And I think it's worth actually going to their website because they've as I record this here in April of 2020, they're trying to make sure people don't get freaked out, right? As we head into the coronavirus recession, not sure for sure what that's going to be called yet. Maybe the Great Lockdown, I've heard, bordering on potentially being like a depression, right? Which is effectively just a severe recession. So they're trying to ease people's fears. So they've even put up a little video kind of talking about why, hey, you don't need to get your money out of the bank. Okay, so here's Federal Deposit Insurance Corporation, and just a very recent video, right? The safest place for your money, trying to make sure you don't go and get it to stick it under your mattress.
At a time of a pandemic like this, it is way too easy to get confused and to have fear about what you should be doing with your money in your accounts, especially as you're looking at the volatility in the stock market and the financial sector. This is what I would like you to take away from this. Your money is safe at the banks. The last thing you should be doing is pulling your money out of the banks now, thinking that it's going to be safer someplace else. You don't want to be walking around with large wads of cash, and you certainly don't want to be hoarding cash in your mattress. It didn't pan out well for so many people. And I will tell you this, no depositor has lost a penny of their insured deposits since 1933 when the FDIC was created. So if you're talking about having your money in a safe place, please keep it in an FDIC insured bank.
So yeah, just trying to keep people. So the goal is not that people use this insurance, right? Because they need to, because the banks fail, because everyone does go for the run. The goal is to not need the insurance because you know you have the insurance. Right? Okay. So what else? Right? So yes, your money's insured, but the government doesn't want to have to use that insurance. And there's other things besides bank runs that can result in a bank going insolvent, that can result in a bank having challenges, right? So there's the reserve requirements, but that doesn't completely, that's not really often enough, right? It'll give a little bit of a buffer for people coming to get deposits out. But let's go back to the scenario where there was $1,000, right, in the bank. They kept $100 in cash in reserves and $900 in loans. Right? What happens if that loan, right? Let's say that loan, that $900 is a loan to somebody for a car. Let's say they default on that loan. So basically the loan is worthless, right? That means they have much more deposits, right? A lot more deposits in the bank, which is a liability to the bank, right? They owe you that money back. A lot more liabilities than they have assets to cover it if the value of their riskier assets, their illiquid assets like their loans or other type of investments that they make, decreases, right? So there's also, in addition to reserve requirements, there's capital requirements, right? What is a bank's capital, right? It's the amount that their assets have to be bigger than their liabilities, right? So it would not be, for capital requirements, it would not be possible to have just the $100 of reserves plus the $900 of loans. So the assets of 1,000 equal the deposits of 1,000. You need to also have equity, right? So there needs to also be more assets than there are deposits, right? So then in addition, if you think about, especially if you've taken accounting, this might make more sense. In future versions of this, I probably should add a little bit of a T account type thing to kind of show this. But let's say that they have to have, say, $1,200 of assets if they have $1,000 of deposits. So there's an extra $200 kind of assets above their deposits, so that if their assets lose value, there's still enough assets to cover the deposits. So requiring a capital requirement basically adds an extra buffer of security for losses for the company or for the bank that helps ensure deposits or protect deposits. So, and why is this very needed, right? Well, when a bank has a situation where they know, right, there's the deposit insurance we just talked about on the previous slide, it creates what's often called the moral hazard, right? They know that there is insurance, so that they feel it effectively opens them up to feeling like, hey, I can take more risks since I know I'm insured. Right? Well, the capital requirements kind of force them to kind of manage that risk in a way that doesn't make their assets so risky, right? So now the exact capital requirements are really complicated because it depends on how much capital you have to have, depends on how risky your assets are, right? Versus, loans versus having derivative securities, right? Basically bets on outcomes of certain things, which we don't need to get into here. But bottom line is, the riskier your assets, the effectively the more of this capital you have to have. So, Investopedia kind of goes over some of the basics of that. The Basel Accords kind of help define that for international banking community. And just a really quick quote from that discussion under the Basel III kind of accords, kind of rules, basically. Don't worry about what the Tier 1, Tier 2 means, but it has to be 8% of risk-weighted assets. Right? Again, the risk weighting, the riskier your assets, effectively the more capital you have to have. Right? So again, trying to keep the system stable, trying to keep the banks, trying to force them to not be so vulnerable when we have a downturn like we are now here in the spring of 2020. So what else does the Fed have? Well, as was mentioned, if you are a commercial bank and the Fed is your bank, you can borrow money from your bank. And if you do that, you do it from what's called a discount window. And that's basically from when it used to be literally a window. And actually, if you go to the Federal Reserve, they basically kind of still have that there, where bankers could come and actually go to the discount window and to borrow money. Now, that's not the way it's done, right? It's more of electronic transactions now, but still called a discount window. Now, this isn't very often used, right? So banks don't normally go to the Federal Reserve to borrow money, partially because it's basically shows that they're vulnerable and makes them more likely to have problems like people taking their money out of the bank. Normally, what happens if one bank is low on reserves and needs to borrow money? They actually do it from other banks, right? And we'll talk more about this in the next chapter on monetary policy. But effectively, what happens here is if one bank has excess reserves, right, more reserves than they need, and another bank finds themselves at the end of the day low on reserves, they basically can borrow money from the other bank temporarily to meet their reserve requirements. Okay, but again, we'll talk more about that in the next chapter. But so the discount window exists, but not very often used. This is how banks short on reserves much more often get them. And in the world that we described in the last part of the discussion, where there's a lot of excess reserves in the banking system, not as much of an issue as it has been in the past when the excess reserves was very, very tiny. Okay. So that's some of the things that the Fed does to regulate the banking system, the financial system, but increasingly, the financial system has become more and more challenging for the Fed to regulate, right? Because the percentage of the financial system that is comprised of the commercial banks that they directly regulate has been getting smaller, right? So basically, the book describes this as the rise and the impacts of the quote unquote shadow banking system, right? So the Fed most directly regulates commercial banks, although they have some ability to regulate some other institutions, but predominantly the commercial banks, right? The ones that are FDIC insured, the ones that the Fed is their bank, right? Over the last 20 years or so, a lot more financial firms that aren't commercial banks have taken on a lot of the roles of commercial banks, providing credit to individuals, some even taking deposits effectively. They don't call them deposits, but effectively that's what they are, holding people's money. Again, causing challenges for the Fed to both manage the money supply and do their monetary policy, and also to regulate the system. Okay. So what are, and again, if you have your money in those institutions and something goes wrong, it's not FDIC insured. And you'll often see that as you're making the investment, just to they're required by regulation to kind of let you know that for sure that, hey, you put your money here, not FDIC insured. Okay. So what are these types of shadow banks? Well, this is not an exhaustive list, right? But one that often people have money in is money market mutual funds. What's a money market mutual fund? Well, we actually talked about that in a bit earlier in the semester. But money market mutual funds are, well, if you have your money, right, in a brokerage account, right? So I have a Vanguard brokerage account. Any money that I don't have invested in some stocks or mutual funds, basically doesn't sit there as a cash, right, like checking account deposit. It goes into a money market mutual funds, which is composed of very, very short-term bonds of very low risk. So bonds of less than 1 year, treasury bonds, very, very high, highly rated corporate, very short-term, less than 1 year bonds. So it's kind of close to being money, but not. Right? So if you have your money in that, it is so commercial paper, right? So that's kind of what the term is for corporate bonds, effectively, that are very short term. So if you have if I have, say, $10,000 in a money market mutual fund, it kind of feels like I have $10,000 in the bank, but it's not quite the same, because if something happens, I could lose that money. Not that likely, but it's not insured. Hedge funds, you might have heard of these. Not something that the majority of us will ever have direct contact with. These are effectively funds from predominantly very wealthy investors that pay somebody to do quote unquote sophisticated, complex, all kinds of different things with their money to try to turn their money into more money. You put your money in a hedge fund, not FDIC insured. Investment banks, so they don't take deposits from individuals, but they certainly provide credit, right? So they certainly create bonds, right? They provide investment advice for companies and governments. They also pool money and create things like mortgage-backed securities that investors buy, right? So they're not really taking deposits, but they certainly are making loans to households. But when you put your money into those mortgage-backed securities that these investment banks make, that money's not protected, no FDIC insured. But the main point here is that is money that the Federal Reserve, right? It's in the financial system, but the Federal Reserve does not regulate. Okay. So as the percentage of the financial system that is these types of institutions versus commercial banks, it makes it harder and harder for the Federal Reserve to regulate. Okay, so that's a quick overview of some of banking regulation, some of the challenges of that. And now, as mentioned, we'll just do a very quick overview of monetary policy, which is an intro effectively to the next chapter. So monetary policy, the Federal Reserve managing the economy, and we'll talk more about some of their goals of monetary policy. Here we'll talk about some of the basic instruments, right? Some of the basic tools that they have for monetary policy, which frankly have been expanded dramatically back for the Great Recession, and also being utilized now extensively as well. So one of the most basic forms or tools for monetary policy, which again up until the Great Recession was the predominant tool, open market operations, where the Federal Reserve bought and sold treasury bonds to try to impact interest rates, amount of money in the economy. So how does the Federal Reserve increase the money supply? By open market operations, buying and selling treasury bonds from banks. Well, when the Fed buys treasury bonds or treasury securities, it increases the money supply, puts more reserves in banks. Well, why does that increase the money supply? Because the banks have more reserves. They have more money to lend out. I'll go through an example on the next slide. If they want to decrease the money supply, right, because there's a lot of inflation happening, we're having an inflationary gap, right, talking from the terminology of the aggregate supply and aggregate demand chapter. They can decrease the money supply by doing the opposite. They sell treasuries, right? So if they sell treasuries to the banks, it takes reserves out of the system. So how does that work? So let's imagine the Federal Reserve buys $10 million of treasury bonds from banks, which is frankly like a penny, right? Where typically they're talking much more in the many billions when they do these types of open market operations. So, but just for an example, they purchased $10 million of treasuries from banks. Well, what does that look like? So here's basically asset liability balance impact on the Federal Reserve. So the Federal Reserve, just like any organization, has a balance sheet, has its assets, has its liabilities. It could also have its equity, right, on the liability side. But bottom line here is when they buy treasuries from banks, it adds those treasury bills, because typically, historically, this has been done with just short-term treasuries. Although again, that was pre-2008. Increasingly, they buy all kinds of assets. But for now, treasury bills, so short-term, less than 1 year, treasury bonds, they buy 10 million of them. So they then effectively owe money to the banks, right? Because remember, the Fed is the banker's bank. So the reserves, that's an asset to the bank, the $10 million, that gets increased when they sell the treasury bills to the Fed, is a liability to the Fed because they owe it to the bank, because the Fed is the banker's bank. And the bank's assets, treasury bills, are decreased because the Fed just bought them. Right? So how does that increase, right? So the money creation process can now begin because there's $10 million more in reserves in the banking system than there was prior to this open market operation purchase of treasury bills from the Fed. Now, right now, the Federal Reserve is buying billions of dollars of treasuries and all kinds of other assets from banks to try to keep things liquid as we delve into this coronavirus recession that is emerging as I record this in April of 2020. So our authors, right, kind of ask the question, you might wonder how the Federal Reserve gets the money to buy these assets from banks, right? Because if you want to buy something, right, you need to get that money from somewhere, right? You need to make the money, whatever. Well, the Federal Reserve has a unique ability to basically make it out of thin air. They simply create it with a mouse click that credits the bank accounts with the excess reserves, right? They basically are kind of above the law in a way. They are the law, right? The money supply is really kind of a construct of this entire system, and they can literally increase it at the click of at a mouse click. Again, I mentioned when we were talking about the money creation process, right, and how if everybody in the U.S. understood how that actually works, that their money wasn't in the banks, that people might freak out. Well, this is something else that if people truly understood how it works, people would probably freak out as far as trusting the banking system, because literally, right, since the financial crisis, they've created trillions of dollars, right? Now they've already, in this last month, here we are, April 20th as I record this, 2020, over the last 4 weeks have created hundreds of billions of dollars by effectively doing exactly this. And not just with treasuries, but buying all kinds of assets from banks. So other tools the Fed can use to manage the money supply but aren't often used will change the discount rate. So the interest rate at which banks borrow money from the Fed. So which again isn't used that often. So if the Fed wants to stimulate the economy, how would they change the discount rate, the interest rate at which banks borrow money from the Fed? Well, hopefully it's intuitively logical that they would lower that interest rate to make it cheaper to get those funds. They could also change the reserve requirements, which again they don't often do to manage the system to try to stimulate things, because it effectively also creates more risk, right, for the banking system if they do so. But so if they want to stimulate the economy, they want to grow the money supply. How would they change the reserve requirements? Well, hopefully, again, it's intuitive that they would lower the reserve requirements so that banks could lend out a larger fraction of their deposits. Okay. So again, that was a very quick overview of the open market operations of the monetary policy of the Fed, and you can consider it mostly just an intro into the next chapter. And that is it for this part 3. And have a great day if you're listening to this, and kudos to you for getting to the end.